Welcome to the All Financial Hour podcast with Steve All.
You know, 7 tech stocks, they continue to just dominate Wall Street. But when you set those few aside, is there still room for the market to climb even higher? Here's our friend Jeremy Siegel of the Wharton School of Business on CNBC.
Certainly, we could have a pullback. I still think the bull trends are intact. But once you take out the Mag 7, we're only, slightly above a longer-term median. So I'm still positive on the market at this time. Of course, any sort of developments could come that could change that. But what I see is still constructive, very constructive.
All right, but for those nearing retirement, Steve, is the bigger risk not missing out on the growth, or is it not being prepared for when the bull market finally steps down?
I think you have to plan for all of it. I think if your plan is based on 6, 7, 8% returns, that might not be the best plan to have, because we are going to have downturns in the market. You start to look at the fact that there's almost every year there's a decline of more than 10%. And most people say, what do you mean? Yeah, that happens on a regular basis. Markets will correct. And the idea around it is will your plan work no matter what happens? When I get the people that come in and, you have to have this just gigantic return to make it work, I think that's very, very difficult. And I look at most investors. My experience over the time is most investors are looking for 3 things. 1, they want to increase their net worth. 2, they want more control over their assets. And 3, they want to pay less taxes. So if you're in that category, it's the idea that we have to look at when we talk about planning. How are you going to replace your paycheck? How much income do you want? What about the preservation of as much of your capital as possible?
The number one fear in retirement is, of course, running out of money. And with talk of a looming recession, more are looking at annuities as a source of guaranteed income security. But they are also very complex here. So, Steve, what are some of the common mistakes that you see when people try to buy an annuity on their own?
The big mistake that I see when I'm looking at annuities is, do I have the right tool for the right job? And many times, I get people that'll walk into my office, they'll say something like, I hate annuities. And I'll look at them and say, which kind? and I get that deer in the headlight look like, what do you mean? I said, there are a lot of different kinds out there. I said, you got the fixed annuity. The fixed annuity pays me a set percentage rate for a set amount of time. Sounds a lot like a CD at a bank, but the CD at the bank is guaranteed, whereas the annuity is guaranteed by the insurance company. Then you have the variable annuity. It can go up, it can go down. It's actually in the market. So you have the market exposure, and there are some fees that can say, okay, if it loses money, we'll pay as if though it wasn't. So there are sometimes a little bit more fees involved in there. There's the one that most people hate it. They'll go, Uncle Joe bought an annuity and he died 3 years later and the insurance company kept his money. That's a single premium immediate annuity. And that's how they did work years ago. But now they're usually period certains. We're going to pay you for at least 5 years, 10 years, 15. Different annuity companies have a different amount so that it's not, I got 3 payments, passed away, and they kept all the money. So those are the things it's got. And then the fixed indexed annuity. That cannot go down due to market volatility. It's not invested in the market. But because it's got a floor of 0, it might have caps on how much it can make. Caps, spreads, participation rates. They can be very complex. And I think that's the toughest part about annuities. People have them and they do not understand how they work. They're just not sure because they can be very complex. And do I have the right tool for the right job? I don't like it when somebody comes in and they say, I've got this annuity that can replace my income, but I don't really need the income. What can I do with it? And that's when I said, it's the salesperson. Wrong tool, wrong job. My Social Security and my pensions covered my lifestyle. Why am I buying more guaranteed income? I don't think that's a good thing. But I think if I'm one of those people that my income is below what my lifestyle expenses are. How do I fill that gap? And I think a tool that can be very good for that is an annuity with an income rider. What's that mean? They're going to pay me that gapped payment for the rest of my life. And if I want to do it for me and my wife, I can do a joint payment for both our lives. So it fills that income need. Now, one of the negatives of that in a lot of cases, it's not inflation adjusted. So we can't put all of your money in there. And that's where I look at it. I think the biggest thing is, am I buying the right tool for the right job? Tell me what you're looking for. Then we'll find what can happen. Because like I said, if you're not sure how to replace your paycheck in retirement, give us a call now. Ask about income planning. Second one, if you have an annuity and you're really not sure how it works and how you're going to fit this into your plan, call, ask for that annuity x-ray, allow myself and my team to assist you to find out exactly what you have so we can figure out the best way to use that in your retirement years.
You know, it's estimated that baby boomers will pass on at least $84 trillion to younger generations by 2045. That's why they call it the Great Wealth Transfer. If you've ever wondered that, some of that money will be passed on in the form of IRAs. Here's tax guru Ed Slott on Morningstar, and he says you want to make sure that it's a Roth IRA.
Those are the best assets to inherit because under this 10-year rule for beneficiaries, most beneficiaries, non-spouses, have to empty the inherited account now after the Secure Act by the end of the 10th year after death. Same thing with an inherited Roth. But they can keep that inherited Roth growing for the full 10 years. They never have to touch it and take it out, all that accumulated growth and compounding, absolutely income tax-free.
All right. Well, tax-free right there. That bell goes off for me. So what are you seeing when it comes to inherited IRAs, Steve? I mean, are clients seeing the value of setting up a tax-free future for their family?
Well, that's the big question that you have to look at it. I've been to a lot of Ed's events, the tax time bomb that we're passing on to our children. See, back when they started, the rules were, when you put it in, we're going to give you a tax deduction for it. It's going to grow tax deferred. And then when you take it out, it will be taxed as ordinary income. When you pass away, if you're married, it can go to your spouse. Then, when your spouse passes away, it can be passed down to your children, and they can stretch it over your lifetime, and you'll be in a lower tax bracket. That was what we were kind of promised back in the 70s and the 80s. Mm-hmm. Well, many of those are not there, and the Secure Act, as he just said, took away that stretch IRA for our children. That's not a product. It's just a philosophy. I'm only going to take out the minimum distributions. Secure Act got rid of that and says they got to bring it out by 10 years. So Ed puts it to the point, are you going to put a tax time bomb onto your kids? So we look at it. If you've got an extra large IRA account between $250,000 to $750,000, and a lot of people go, what do you mean extra large? The average IRA 401k balance out there is between like $170,000 to $190,000. So if you've got that double X, you might spend those assets down. And when your children have to take it over a 10-year period, it might not throw them in much of a higher tax bracket. But if you've got a double X between $750,000 and $1.5 million, then you could be passing a tax time bomb onto your children. Mm-hmm. Because with a 6 to 7% growth during the rest of your life, how is that going to affect your children? And if you've got a triple X 1.5 or more, you probably will. You're probably not going to spend down those assets. So we look at it. Who is more apt to be able to pay the taxes? You, at a rate you decide, or whatever the government decides that our children should be paying in the future. And that's where we have to look at that. I sit down and I do Roth conversion analysis for a lot of people. And I've gotten that deal. Steve, I wasn't planning on leaving any money to my children either. And I said, neither was I. But would you rather leave it to your children or would you rather leave it to the IRS? Thank God most people would rather leave it to their children than the IRS. So I'm going to say, if you're in that category, if you have more than $500,000 in your IRAs and 401ks, give us a call. Ask for that tax analysis. Let us look at it to see if Roth conversions would make sense for you, and would it make a lot more sense for your children.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisory requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group, LLC.
This radio show is intended for information purposes only.